Let's solve an accounting past paper together. It's from 2019, the summer session, May, June, paper 1-1. All right, let's start. Okay, solve 10 MCQs. The employees of a business are highly skilled, but this is not recorded in the financial statements of the business. Which accounting principle is being applied? So we do not record the skills of our employees, right? Like how can we record it, right? So let's say there are two businesses and one says my employees are more skilled, so my business is worth more money. Does that make sense? Like, can we record it in the, so let's say, can we record in our assets, right? Can we record it, can we record that I have $10 worth of brain, I have $50 worth of skills, right? Even though you go to the job because of your skills, but still you're getting paid, but still that cannot be recorded in a monetary term, right? So it cannot be measured in terms of money. That's why we are not recording this. So skills are not recorded. Motivation is not recorded, right? These are intangible things. We cannot see them or we cannot judge them based on money. We can't judge their worth. So they can't be measured in money. That's the rule applied, money measurement. This one, going concern, means um, having a perspective, being optimistic about the future, okay? Not making decisions thinking that the business is going to end in the future, so let's make decisions according to that, right? That means going concern, okay? So they don't make any wrong decision, any biased decisions. Okay, prudence is considering the possible losses, not realizing profit before, and realization is not realizing profit before it's earned. Okay, so let's say you have a deal with a person, and you say that I'm going to sell you 50 units of something. You agree, okay? So you don't just go ahead and record it just because you agreed. You will record it when the goods have been goods have been sent to the person. Then you would realize the profit, realize the sales, okay? Okay, next. Question number B. Khalid started a business on 1st April 2018 with a capital of 90,000. He provided the following information. Okay, so this is basically the opening capital. We have that information. He provided the following information on 31st March. What's the question? What's the profit for the year? All right, so if you remember, the profit is transferred to your capital account, right? So let's say there's an opening capital equals closing capital, right? But not just that. Opening capital equals closing capital plus any profit we made. Okay, right? So yeah, so whatever is the increase from the opening capital, whatever is the increase in the closing capital, that's because of the profit, right? Um, okay, so he provided the following information: non-current assets, current liabilities. Okay, so do you remember how do we calculate capital? So the accounting formula says you can say assets minus liabilities, uh, liabilities equal capital, right? Capital. Assets minus liabilities equal capital. So if you do 75,000 minus 32,000, oh man, what I'm saying, I'm a bit sleepy actually. 75,000 plus 32,000 minus 24,000, right? Now remember, drawings during the year, these drawings have been taken out from your business, even though we made this money in this year, right? So these drawings were taken out of your bank account or any kind of asset account. So we'll also consider this in our assets. This is one way to do it. Okay, this is the way I do it. But there are of course easier and maybe there are easier ways to do it. But this is one way to think about it. So 75. Let's ignore the zeros. We'll get this correct answer. Plus 32 plus 19. Now remember, if you revise the chapter, you will have a better way to do it, I guess. But I'm doing it in this way. So if you think about it, it makes sense because this was supposed to be in bank, even though it's taken out, but still we'll consider this as in our bank account, right? Because it has been taken out and transferred to your capital account. All right, so 75 plus 32 plus 19, let me calculate. 75 plus 32 plus 19 minus 24. It gives me 102. We ignored the zeros, let's add them back. This is my way to do it, and you can add the zeros in however you like. So this is the closing capital, right? What was the opening capital? 90,000. So what is the increase in our capital? 102 minus 90, you will get 12,000. Is it a loss or a profit? It's a profit because it has increased. It's 12,000 profit. Okay. How is the cost of production calculated? Okay. Cost of production, I hope you remember it from the manufacturing accounts. Direct materials plus direct labor plus direct expenses. This gives us our prime cost, remember? Prime cost. And then direct materials plus direct labor plus direct expenses plus factory overheads. Okay, to some extent, that's all right. But then there's another thing, right? There's another thing. There's something called work in progress. Okay. Now here I want you to focus here. Decrease in work in progress. Do we add it or do we subtract that? So what is the cost of production? How much did it cost you to make the products, right? So decrease in what does that mean? It means when the year started, you had certain work in progress. So let's say 10 was work in progress, but now it has become 5, or let's say it has become 4. So how much has decreased? It has decreased by 6, right? It has decreased by 6, right? Now it means that you have you have completed these products. So you have made 6 units or six, let's put dollars to it, right? So you have made goods worth $6. So that should be included in your cost of production, right? Do you understand? So we add the decrease in work in progress. It means that at the start we had some incomplete work. At the end we have some incomplete work, but it's lesser. It means we have completed some of the work during the year. That's why it has decreased. So since we have completed some of the work during the year, that work cost us some money. So that is included in our cost of production, so it should be added. That's why it's option C. I hope you got this. If you have any questions, you can ask me. All right, next. Lisa returned goods previously purchased from Tara. Tara is the seller, Lisa is the purchaser, the customer. How did Tara record this? Okay, Lisa returned the goods. So what is involved? Sales returns, right? From the perspective of Tara. Not from the perspective of Lisa. From perspective of Lisa, purchases returns. So this is not an option. Try to cancel the options which doesn't make sense. So these options do not make sense. Now, sales returns are always debit, right? So I guess that's pretty straightforward. And we won't be receiving this money from Lisa. Lisa was our trade receivable. Now it's not. We won't receive the money, right? So that's option D. Okay. When preparing his financial statements for the year ended 30th April 2019, Tibogo recorded his opening inventory of 6400 as 4600 in error. So, okay, what's the difference? Let me calculate. 6400 minus 4600 gives me 1800. So, uh, there's an error of 1800. So 1800 has not been recorded. Okay, lesser amount of 1800 less is recorded instead of in place of opening inventory. What was the effect of this error? Now look, opening inventory increases our cost of sales, right? If you remember the income statement, costs of goods sold, right? We do sales minus cost of goods sold. Now in cost of goods sold, what do we have? We have opening inventory, right? We have purchases. So these two things increase our costs, right? Does it make sense? It makes sense, yeah. Minus closing inventory. And this closing inventory, because we haven't used those inventory, it means it's not the cost. If we have used the opening inventory, that's our cost. It means our costs are, you can say, understated. So our costs are understated by 1800. It makes sense, right? Because opening inventory increases the cost. Okay. So let's say instead of recording 5 as an opening inventory, I recorded 10. So my costs are increased. But in this case, instead of recording 6,400, I recorded 4,600. So my costs are underestimated. Cost of goods sold is underestimated. It costed me more to make the product. Understated. So it was more expensive to make. Okay. So sales minus cost of goods sold, my gross profit will be overstated. I will think that I have made a lot of profit, but I forgot to consider that my costs of goods sold are understated because of the opening inventory, right? You see the effect, how it is linked to your gross profit, right? Opening inventory increases your costs. It is supposed to increase your cost, but since we have understated the opening inventory, it understates our costs. As a result, the profit is overstated. We think we have made a lot of profit even though we haven't, because we have not considered our 1800 of inventory. We have ignored this one. Not ignored, but in error we have um, miscalculated. So this is the correct point. So it would be one of these two, right? Now, of course, if gross profit is overstated, it will carry on the same effect to the profit. Okay. Now there's no, so it's not, you see, they're not matching. Okay, it's supposed to be a take care, then we'll move on with this. So this is cancelled. These both are obviously cancelled. We have one option only. We don't even have to look at this one, right? An effect on capital, right? We don't even have to look at it, but still, it will be overstated because, yeah, of course, capital will be overstated because profit is overstated. The profit is transferred to the capital account. Capital account will be overstated because profit is added to your capital, right? So it makes sense in all these three boxes. Next question. Amrik started business on 1st January 2017 and purchased a machinery costing $18,000. He decided to depreciate the machine at 20% per annum using the reducing balance method. No depreciation was to be charged in the year of disposal. So this is the machine was sold in this year. In 2018, there's no depreciation in this year, okay? There's depreciation in the year 2017. The good thing is they start the year from 1st January, so it's easier to make calculations. There's no confusion with the months. Right, so 1 year's depreciation will be charged. The machine was sold for 13,300. What do we have to calculate? What is the profit or loss on the sale of machine? Okay, so first we'll calculate. So machine was valued at this much in the market. Okay, we sold it for 13,300. Let's deduct the depreciation and look at the actual value of machine, not the one we sold it at. So what was the net book value for machine, right? So the cost was 18,000. What will be the depreciation in the first year? Will be 18,000 multiplied by 20%. 18,000 minus what will be the depreciation? 18,000 multiplied by 20%, 3,600. 3600 equals, what is the value then? 18,000 minus 3,600. 14,400. That's our net book value. $14,400 is our net book value. It means we assumed that this will be the worth of our machinery after 1 year. Okay, so in our books, our machinery is worth 14,400. How much did we sell it for? 13,300. Did we make a profit? No, we made a loss because we thought we would get this, but we got this. So we valued it at this, we got this. So 14,400 minus 13,300. Sorry for my bad handwriting. Obviously, you'll get 1,100. And that's a loss. Even if you calculated the value, you see, so if you have done half of the task, you've calculated the value, all other options are wrong. So you don't even have to worry about profit or loss, you just know the value. That's it. Okay, move on. Financial information must be free from errors and bias. To which accounting objective does this refer to? Comparability? No, comparability means it should be we must be able to compare it. So if we apply the the debit credit rules and all these rules, that will make it comparable. Okay, so if we follow the IAS and all the rules of accounting, that will make it comparable. So this isn't okay. It's not related to errors. Relevance is, let's say, the if the reports are timely. Okay, so if the information, the financial is available on time, so it will be relevant. Relevant means how relevant it is. So if let's say I need to know my profit, will 2 year old profit or loss statement or 2 years old income statement help me? No, it won't. It has nothing. Doesn't have anything. Sorry, doesn't have anything to do with errors or bias. Reliability, yes, that's the point. Reliable means how trusted the financial information is. So can you trust it or not? Okay. Reliable is basically trust, and you can only trust it if it is free from errors and bias. Okay. If it's full of errors and bias, you cannot trust it. You can rely on it. Understandably doesn't have anything to do with it. Basically understandable. So again, you follow the rules, and it becomes understandable. You prepare it in a certain format, it becomes understandable. Next question. Amelia rented premises to a tenant. So Amelia is the renter, the landlord. At the end of Amelia's financial year, the tenant had paid 2 months' rent in advance. Okay, so the person, so let's say you are Amelia, you have received already. Okay, you're supposed to receive it next year, but you have already received it. Which entries would Amelia make in her ledger? Credit the rent payable account. Is it rent payable? No, it's receivable, right? You're the receiver. Amelia is the receiver. Wrong. Again, rent payable? Wrong. Rent receivable? Relevant. Credit the rent receivable account and carry down as debit balance. Wait. Credit the... No. It was paid in advance, right? What does that mean? It's a liability for you, right? It has become a liability for you. You have to give that service in the next year. And remember, credit this rent receivable, and you have to be interested in this part. Carry down the balance. Okay, so this is basically the balance brought down, right? The balance brought down should be on the credit side. Why? Because you have received it in advance, right? If you're aware of this chapter, it becomes your liability. You have to give the service, you have to provide the service later because she has already paid. Your renter, your tenant has already paid you the money, right? So it becomes a liability on you. Okay, so this is the answer. This isn't. John paid Tahir credit supplier 200 by check. This was credited to the account of Tariq, another credit supplier. Okay, so it was supposed to be debited in the Tahir's account. Tahir was supposed to be debited because John paid him the money. The cash or bank will be credit. Tahir will be debit because he's um, our trade payable and we are reducing it. So it becomes debit. Our liabilities are decreasing by 200. Tahir was supposed to be debit. So in all these cases where Tahir is supposed to be, okay, Tahir was supposed to be debit, this makes sense. And Tahir is debit here. These options are irrelevant. Tahir should be debited because we did not do it. This was credited to the account of Tariq. Tariq has nothing to do with it. Okay, Tariq has no business with what happened here, the mistake. Why was he credited? So to solve the matter, we have to debit him again. We have to debit Tariq because we credited Tariq for no reason. So we'll debit Tariq. Where is Tariq debited? Not here. So this is the answer. Okay, and for every debit entry, there must be a credit entry. And if there is no credit entry, so it will go to suspense account. Okay. Okay. A business provided the following information. What was the rate of inventory turnover? Simply you have to apply the formula. Okay, the formula is cost of goods sold over average inventory. So cost of goods sold is opening inventory. Again, I'll be ignoring zeros. You don't have to do that. Okay, I'm just trying to save some of my time. You don't have to do that. You have to write the full just to avoid any mistakes. Opening inventory plus purchases minus closing inventory over average inventory. What is average inventory? It is opening inventory plus closing inventory, all of it divided by 2. Okay, let me put it into my calculator. Here we go. It is 12.4. If you put this in your calculator, and simply this is just a formula, nothing else. That's it. That's why the ratios help you. They give you free marks, and that's how you get 10 marks in your exam. All right, so let's move on to the question answers. We have completed the MCQs, right? Yeah. Olivia is a trader. Sales and purchases are made on both cash and credit terms. Olivia maintains a full set of accounting records and prepare control accounts at the end of each month. Okay. Name the book of prime entry which Olivia would use to obtain the following information when preparing her control accounts. Remember, whenever you prepare control accounts, what is the source material? Where do we get your source? What is the source of your data? It is books of prime entry. Okay. Remember, not the ledgers or anything, because there are reasons explained in the chapter. So you get the information from books of prime entry. Now, what are the books of prime entry? There are, I guess, seven. Yeah, seven books of prime entry. There is sales ledger, purchase, sales journal, purchase journal, sales return journal, purchase return journal, cash book, petty cash book, and general journal. Right. I hope you are aware of these. Returns to credit suppliers. Suppliers, so we are the purchasers, right? If they are the suppliers, we are the purchasers. So that is purchase return journal. Remember, you have to write full form in your exam, okay? Do not write the short form, write the full form of everything. Checks received from anything related to cash is cash or check is cash book. Contra entry. What is contra entry? I think it's yeah, it is explained in the control accounts video. So yeah. Anyways, it is entered in your it is entered in your general journal since it doesn't belong to purchase, sales, or cash or anything like that. So it'll be in the general journal. Bad debts written off. Again, that's one-off thing, right? It doesn't happen every day like purchase, sales, cash. It's one-off thing. So this is also general journal. Complete the table by placing a tick in the correct column to indicate which will be sales or control account. Okay. If the item does not appear, place a tick in the no entry column. Right. So where do we write this? In our control accounts. Credit sales, remember control accounts, sales ledger control accounts equals trade, mm, mm, trade receivables. It's the total trade receivables account, so it's our asset, right? It's an asset account. Credit sales, so when you make sales on credit, it becomes your trade receivable, right? So it increases your trade receivable, it increases your asset, so that's your debit. Cash sales won't come here because it, it only it only it's only concerned with the credit entries, creditors. So, I mean the debtors, okay? Cash refund to credit customer. So when credit customer pays, the payment comes on the credit side of our trade receivable, right? Because now trade receivables are decreasing. But let's say we give him a refund, we give him or her a refund because the other person was overcharged. So since bank or cash is written on the credit side, the refund will be written here, right? On the debit side. Cash refund is written on the debit side. And it makes sense, what will the double entry? Since we're paying him or her from our bank or cash will be credit, and the person will be debit. So that makes sense. Cash discount allowed by credit suppliers. No, it doesn't have anything to do with it because we are the sellers here. We're not talking about suppliers. We're not talking about purchase ledger control account. Contra entry is it is as if again this was explained in the control accounts video. So contra entry is basically as if you have paid your amount, right? And the double entry will be made in purchase ledger control account. It's explained in details in the other video. So it'll be credit as if you paid it. So credit as if they paid it. I mean, trade discount allowed to credit customers. No, it comes nowhere in your books. Trade discount doesn't come anywhere. Interest charge on credit customers over the account. Again, this will increase your trade receivables. We'll receive the money. So that's that here. Okay. So that's how you get how many? 7 marks. Easy 7 marks, right? And here you get 4 marks. Very easy to get these marks. So let's move on. State the meaning of the following terms. Bad debt. What is a bad debt? Um, so amount which will not be received from the customer, right? Amount. I guess I won't write it all. So amount which will not be received by the business from its customers. Okay, for any of the there's quite a few reasons for it. Bad debts recovered. Bad debts which are paid after they have been written off. Okay, so let's say bad debts which have been paid by the credit customer after they have been written off as bad debts. Okay, so they partly or fully pay the amount at a later date, maybe next year, maybe after 2 years. You just have to add the definition. Provision for doubtful debts. So provision for doubtful debts is basically the estimate of the estimate of the amount business will lose because of bad debts in a financial year. Okay, that's it. Next, Olivia's financial year ends on 30th April. On 30th April 2019, Olivia received 200 in cash from Ben. So there's Ben's account. He was owing us 360. He owed us 360, and he paid 200 in final settlement of the account amount he owed. The balance of Ben's account was written off as irrecoverable. So the balance was written off as irrecoverable. It means bad debt. Okay. Now he made a payment of 200. 200 goes to the bank. Right on 30th April. April 30. Okay. Bank 200, and the rest of the amount $160 goes to bad debts. Bad debts, which is here, and you will close this account, right? Bad debts account, bad debts credited here, so debited here, so 160 coming from Ben. Okay, and what do they say? Do we have to? Yeah, year-end transfer. So any necessary, which means transfer this to the income statement, obviously, as an expense, right, for the year. So total to date till April 30, this was our bad debts, and then Ben also ran away, or he did something which made us lose some money. So let me add these. 544. Where does the amount go? 544. It goes to the income statement as an expense. Okay, April 30. Let's move on. Olivia maintains the provision for doubtful debts of 3% of the trade receivables at the end of each financial year. At the end of 30th April 2018, the trade receivables amounted to 13,500. Okay, and then this maybe current year we're talking about. This is the year in question. The trade receivables amounted to 12,800. They have decreased, right? Okay, they have the trade receivables have decreased. It means our provision will be decreased. The difference of the provision will be our income in the income statement. Okay, no information is given here. There will be a certain balance brought down from the previous year, right? So we are preparing it for 30th April. What will the balance brought down from the previous year? It will be 13,500 multiplied by 3%. Okay, let's multiply this. It gives me 405. Okay, next. Similarly for the okay, and also this is 2018's 1st May, right? Okay. At the end of the year, we'll write balance. Remember to leave some space for income statement amount, income statement, whatever will be transferred. We'll get the balance of income statement. So let's write balance CD for the next year's balance, which will be 3% of 12,800. Calculate this. You'll get uh, you'll get 384. 384 brought down on 1st May 2019. 2019 May 1st. Balance brought down. And here there will be our closing balance on April 30, right? Here also April 30 to the income. What will be transferred? The difference between the two, right? What is the difference? So the bigger amount is 405. 405. The difference is 405 minus 384. You get 21. This will be transferred to income statement as an income. I'll end the video here. I know it was a bit slow, but I was trying to give you as much detail as possible. Okay, so yeah, I'll record the rest maybe later. So for now, this is it.